As we talked a little bit earlier, if you have a disregarded entity, a tax transparent entity, the U.S. person would be the beneficial owner. So if you have a U.S. person who's the beneficial owner of a tax transparent entity, it's considered a U.S. person. So if you have a tax transparent entity in the Caymans, for example, and it's owned by a U.S. person, even though it's formed in the Caymans, it's actually still considered a U.S. person for FATCA purposes. So under the IGA, what do Brazilian institutions have to report to the Brazilian authorities? Well, they have to report the name, address, U.S. taxpayer ID number of each U.S. person that holds an account at their institution. If they don't have a social security number, if they don't have a U.S. taxpayer ID number, they'll report that account holder's date of birth. They then also have to account the name, address, and U.S. taxpayer identification number of each U.S. person that controls a non-U.S. entity. So if the account, for example, is held in the name of a Brazilian corporation, the institution has to see whether or not a U.S. person controls that corporation. And for purposes of the IGA, control means they own more than 50% of either the voting power of the stock or the economic ownership of the corporation or partnership. It applies to partnerships as well. The Brazilian institutions then have to also report the account number, their name and their ID number, the account balance as of year end, or if the account was closed, how much was in the account immediately before closing the account, and the total amount of interest, dividends, and gross proceeds of property sold or disposed that was put into the account. Now, generally, there's no reporting required for accounts that are under 50,000 US dollars. If the value of the account is under 50,000 US dollars, there's not going to be any reporting required. However, you do have to aggregate all the accounts that are in the name of that person at your institution. You can't get around this by putting $49,000 in 10 accounts at one bank. If you do that, then it's going to be reportable to be considered an account of $490,000, not 10 $49,000 accounts. So that's what Brazilian institutions have to report. What do U.S. institutions have to report? Well, they have to report the name, address, and Brazilian tax ID number of their Brazilian account holders, the account number, the name and identification number of the U.S. institution, and the amounts of dividends, interest, and other U.S. source income paid to the account holder. Now you can see there's some significant differences in what U.S. institutions have to report and what Brazilian institutions have to report. For example, U.S. institutions only have to report U.S. source income, whereas Brazilian institutions have to report all income. U.S. institutions don't have to go into as much due diligence about entities. The Brazilian institutions do. Now, this is how the IGA is currently drafted. This isn't to say that it's not going to change in the next year or two to basically make U.S. institutions report the same thing. So you need to be aware that this thing is ever changing and evolving. So when will this exchange occur? Well, under the IGA, this exchange is supposed to occur by the end of September of every year. Now, the U.S., the IRS has already said that they've exchanged information with some countries. They haven't disclosed which countries they've exchanged information with already. I'm not sure if Brazil has been on that list or not because, as I said, it's not public knowledge. The IRS did give an announcement that they're going to prolong or extend the deadline for information exchange until the end of this year because they are aware that there's some complications in other jurisdictions about setting up the exchange server. So by the end of this year, supposedly, we're supposed to have full information exchange, but of course that can always be extended. Also under the agreement, each party has to certify to the other about their security standards when it comes to maintaining information and confidentiality. So the U.S. IRS and the Brazilian taxing authorities have to agree that each country's procedures are implemented in a way to maintain confidentiality and security. Now, if the Brazilian institutions have minor errors while trying to comply with the IGA, that doesn't make them in default of the agreement. It's only major errors. So, for example, knowingly not reporting U.S. institution or U.S. account holders, that would default the agreement. Minor flaws, minor failures won't. And it's also interesting that under the IGA, the institutions can contract with third parties to do their reporting requirements and their Fatca obligations. The institution still remains liable and accountable, but they don't have to do it themselves. They can contract with a third party to help them take care of their obligations. So under the IGA, there's an extensive due diligence process that Brazilian institutions have to follow to identify U.S. accounts. And there are different rules for accounts that were pre-existing as of June 30th, 2014, and new accounts that are being opened. So let's talk about the rules for pre-existing individual accounts. If the account is valued at less than 50,000 US dollars, no due diligence is required. That's because, as I've stated earlier, generally no reporting is required for accounts valued under 50,000 US dollars. There's a limited review for accounts that are between 50,000 US dollars and $1 million US dollars. This limited review has to be completed by June 30th of next year. And then there's an extensive review for any accounts that exceed $1 million US dollars. The due diligence rules under the IGA use similar concepts as the anti-money laundering and the know your customer rules and regulations. So the limited review, these are for the accounts that are between 50,000 and $1 million. The institution has to conduct an electronic search of its records to determine which accounts are held by U.S. persons. So they're looking for things that are called U.S. indicia. These are things that might indicate that the person is a U.S. person. So for example, if the account holder is identified as a U.S. citizen, a U.S. place of birth is listed, current U.S. mailing address, a U.S. telephone number, a forwarding address that's in the U.S., standing instructions to transfer funds from the Brazilian account to a U.S. account, or a power of attorney or signatory authority holder located in the U.S. If the institution conducts this review and they have this U.S. indicia, they have to presume that the account is held by a U.S. person unless they get documentation stating otherwise. So for example, if they could get a copy of the account holder's foreign passport, or the account holder signs a W-8 Ben certifying that they are a U.S. person, or that they're a foreign person, or they give some written explanation as to why they're using a U.S. mailing address or a U.S. power of attorney. The only one of these indicia that requires a specific explanation is if a person is listed as having a U.S. place of birth. As you may or may not know, the U.S. considers anyone born in the United States automatically a U.S. citizen. So if the place of birth on the account is listed as a U.S. place of birth, that person must give documentary evidence that they've relinquished their U.S. citizenship. So that's the only case you have to actually get a formal document that they've renounced citizenship, is in the case of listing a U.S. place of birth. So if the account has exceeded $1 million, there's more that's required under the due diligence rules. Not only do you have to do an electronic search of the records, you have to do a physical paper search of records. So you have to review documentary evidence, account statements. You have to review the account opening document and any sort of forwarding instructions. You have to look at the paper itself to determine whether someone is whether the person is a U.S. person that holds the account. So those are the rules for pre-existing accounts. What about accounts, new accounts that you're opening today? Well, again, no review is necessary if the account is under 50,000 US dollars. However, once the account reaches or goes over 50,000 US dollars or is initially opened with more than 50,000 US dollars, within 90 days or within opening the account, you have to obtain documentation about the account holder's Fatca status. So that's going to be the W-8, the W-9, you have to get that information. There are different due diligence rules that apply to accounts held by entities. In the case of entity accounts, no review is necessary for accounts that do not exceed 250,000 US dollars. However, you do need to conduct due diligence review when that account exceeds $1 million US dollars. And like individual accounts, the due diligence for pre-existing accounts has to be completed by June 30th of next year. So for pre-existing entity accounts, you first have to determine whether the account holder is a U.S. person. So you look for U.S. indicia. For example, place of incorporation, U.S. address. If you have these U.S. indicia, you have to treat the account holder as a U.S. person unless you get other appropriate documentation. If you determine that the entity holding the account is another foreign financial institution, you have to obtain that institution's GIN number and then verify that with the IRS. If it's not listed on the IRS website, you have to consider it a non-participating, a non-compliant institution, and you'll have to report information about payments made to that institution. If the entity is not a financial institution, if it's some other foreign entity, then you have to determine whether the entity is a passive, meaning most of its income comes from passive sources, or if it's an active. And if it's a passive, you then have to conduct further review to see if any U.S. person controls that foreign entity, has over 50% ownership or voting power. The rules are similar for new accounts being opened by entities. No review is necessary if the account is 50,000 US dollars or less. However, once it exceeds $50,000, then you have to go through the due diligence review. You have to determine whether it's a US person, whether it's a Fatca compliant FFI, whether it's an active NFFE or a passive NFFE, and then inquire about its US owners. Now, under the IGA, if the account is being held by another Brazilian financial institution, you don't have to worry about Fatca compliance under the IGA. Also, a special rule put in the IGA that's different than the Fatca law generally is that if an account holder doesn't give you documentation, doesn't provide you a W-8 or a W-9 or anything like that, you just have to provide that information to the Brazilian taxing authorities. Normally, under the Fatca law, if you have an account holder that doesn't give you documentation, you're supposed to close the account. That's not the case under the Brazilian IGA. You only have to report that information to the Brazilian taxing authorities. Now, the IGA lists a number of entities that are exempt or excluded from reporting under the IGA. These include Brazilian governmental entities, international organizations that are headquartered here in Brazil, broad participation retirement funds. This means that not one single beneficiary has a right over more than 5% of the fund's assets. Narrow participation retirement funds. These are retirement funds that don't have more than 50 participants. Then there's the financial institution that has only a local client base. This is a Brazilian financial institution that doesn't have a fixed place of business outside of Brazil. They don't solicit customers outside of Brazil. And they have to have procedures in place to identify U.S. account holders, and they either have to report those account holders or close their U.S. accounts. And at least 98% of the value of the accounts is held by Brazilian residents. If you meet this exception, you don't have to report anything under the Brazilian IGA. Another exception is a local bank. This means they don't have a fixed place of business outside of Brazil.